Well, thank you all. Thank you for coming today and for joining. This is the third seminar in the 2018 CDH Risk Seminar Series. We will have another seminar in June, and the topic will be sexual harassment in the workplace. And we will be sending out an announcement. Look for that in the next week. And we hope you can join us for future seminars as well. Our topic today is the new revenue recognition standard. Just very briefly, in case some of you don't know me, my name is Davidson. I'm a senior manager at CDH, and I've been with the firm now for about 13 years in the assurance department, and then also in our business advisory services. So without further ado, I'm going to jump into this topic. There's a lot that we're going to cover today. As we go through, if you do have a question, please stop me, raise your hand, and we will also provide time at the end for question and answer once we get through the presentation. I'm also joined today by Barry Coyne, and he is also going to speak on software and legacy considerations relating to the new standard. So this is an overview of our agenda for today. I'm going to give you a little background on the standard. I'm going to give you an idea of what you will need to do to adopt and implement the standard, the steps to implementation. And we're going to look at a case study. And by case study, what I mean is we're going to look at a hypothetical contract, and we're going to break it down based on the new revenue recognition standard. And then we'll spend a few minutes on presentation, disclosure, and transition. And then Barry will say a few words about legacy system considerations as it relates to the new revenue recognition standard. So the new standard, ASC 606, it is truly a global standard. So this standard was developed by the Financial Accounting Standards Board in collaboration with the International Accounting Standards Board. And the goal is to have a common global standard. And the Financial Accounting Standards Board issued the new standard in 2014. And at the same time, the International Accounting Standards Board issued International Financial Reporting Standard number 15. And they are both called Revenue from Contracts with Customers. And so this is the culmination of many years of work and effort to converge international accounting standards and U.S. accounting standards. So when does the new standard go into effect? Well, for public companies, the standard is already in effect. For non-public companies, and I assume everyone here is non-public, you have to adopt the new standard for fiscal years beginning after December 15th, 2018, which is, if you're a calendar year company, that would be effective January 1, 2019. If you're a March year end, you would adopt as of April 1, 2019. So, as you may be aware, current U.S. accounting rules have many industry-specific requirements. So, for example, if you're in the airline industry, there may be separate revenue recognition rules that apply specifically to you. Well, under the new standard, those industry differences are virtually eliminated. The standard applies to all companies, regardless of industry. Now, the standard is called Revenue from Contracts with Customers. So as you might guess, certain transactions do not fall under that umbrella. So I'll give you two examples. Number one, if you lease equipment to your customers, leasing transactions do not fall under the new revenue guidance. There are separate accounting standards for leasing. Another example would be insurance. So if you look in the guidance, it provides you with a list of the types of transactions that are excluded. And finally, the new standard provides a 5-step model for revenue recognition. So if you think about current U.S. accounting rules, you recognize revenue when it has been earned and when it's realizable. Under the new standard, there's a 5-step process you have to go through before you can recognize the revenue. And let's look at it real quick. And I'm not going to spend too much time on each step here, because as we go through this contract, as we go through our case study, we'll get into more detail on each of the steps. But the 5 steps, first is to identify the contract. So everything begins with contract. And I know some of you, I've been asked by many clients, they tell me they don't have contracts. So we'll define what a contract is in just a few minutes. After you identify the contract, you have to identify the performance obligations that are embedded in that contract. So, for example, let's say you sell equipment to a customer and you also install the equipment. Well, depending on the situation, the sale of the equipment and the installation, those could be 2 separate performance obligations. So step 2 is to identify the performance obligations in the contract so you can account for them properly. The third step is determine the transaction price. And, you know, the transaction price may not be the price on the purchase order from the customer. Okay, so there's some things you have to consider in determining the transaction price that's applicable to that contract. Step 4, once you've determined the transaction price, you have to allocate the transaction price to the different performance obligations embedded in the contract. So you may have a contract that has 3 different performance obligations. So you have to take the transaction price and you have to allocate a portion of that transaction price to each performance obligation. And then finally, you recognize revenue. You recognize revenue as you fulfill a performance obligation. So if you have a contract that has 3 different performance obligations, you may recognize revenue at 3 different times. You may recognize revenue in the current period on 1 performance obligation, and you may recognize revenue in the future period on another performance obligation in the same contract. So this is the new process. And just for purposes of the overview, let me give you just a few takeaways with regard to the new standard. As you might guess, it requires management judgment. One difference between the new standard and current accounting rules, current U.S. GAAP, is that U.S. GAAP has always been rules-based. So there are specific rules, and you apply those rules. You identify the rule that applies to your situation, and that's how you account. But the new standard is principle-based. So it provides guidelines, and it's up to you to look at the facts and circumstances in your situation and apply those guidelines appropriately. New disclosures. We wouldn't have a new standard without new disclosures, right? The good news for non-public companies is that you're going to be exempt from many of the disclosures. So public companies will have a lot more as far as disclosure requirements than non-public companies. And we'll touch on some of the new disclosures later on. And then finally, a key consideration is to look at your accounting software and see if it has the capability you need to handle the new standard. So this is something you need to look at as you plan, as you prepare your implementation plan to adopt the new standard. So this is kind of a visual depiction of the implementation process. And it starts up here with understanding your current situation. And then it comes down identifying changes. So for example, how is the new standard going to impact bank covenants? Or if we have commission arrangements with salespeople, what's the impact going to be because of the standard? The third step, strategy development. That's where you meet, you form an implementation team, and you come up with a strategy to implement the new standard. And then finally, implementation and monitor and improve. And it's an ongoing process. So over time, you may have new types of revenue sources. And so you'd have to go back through the process and assess how to account for that. So here's some key points that you should consider with regard to implementation. First of all, have you identified all of your revenue sources? What are the types of transactions that drive your revenue? So the new standard, as we said, is based on contracts. And so you have probably hundreds, if not thousands, of customers. And so you don't go through each contract. You want to bundle and group the contracts that are similar, that have similar terms and characteristics, so you can evaluate and determine how to treat those contracts. Identify information gaps. So that could be information that you need in order to apply the standard that you don't currently track or that you don't currently have available through your current processes. And then create a project team implementation plan, evaluate the contracts based on the new standard, review your system capabilities, and then prepare documentation. For those of you who are subject to audit or review, it's going to be very important to have the documentation of your judgments and your process to support your accounting treatment. And then finally, last but not least, your accounting policies will need to change because we have a new standard and the rules are different. So real quick, let me just ask a quick question. The first step in revenue recognition under ASC 606 is to collect payment from the customer. All right. How many say true? How many say false? Okay. So it would be nice if the first step was collect payment, but unfortunately. Okay, so let's go into a contract real quick, and let me give you a little background on this hypothetical company. ABC Company, they manufacture widgets and they distribute related equipment that's imported from overseas. So they manufacture locally, but they also import machines from overseas and sell in the United States. There are three primary revenue sources: revenue from sale of widgets, revenue from sale of equipment, and revenue from installation and training. So those are their three primary revenue sources. And then there's a couple of other facts that we need to take note of. Number one, ABC provides a 1% discount to all customers if they pay within 10 days of invoicing. Number two, ABC currently has a marketing program, and if you purchase in excess of $50,000, you get a 10% rebate on the amount over $50,000. That's their current marketing program, incentive program. Number three, ABC has a warranty. And the warranty, the basic warranty, covers all equipment sold for a period of 2 years. But as part of the warranty, ABC provides an annual maintenance check of the equipment. So that's the basic warranty. So the customer doesn't request that. When they buy the equipment, that's the standard warranty that ABC provides. Now, customers also have an option. They can purchase an additional 3 years of warranty coverage. Okay? So as we go through this contract, we need to keep some of these facts in mind because they're going to be important as we analyze the contract under the new revenue rec standard. So the first step in the process is to identify the contract. So again, I mentioned earlier that many of my clients have asked me or have told me we don't have contracts. We do purchase orders, for example. But under the revenue rec standard, there are 3 requirements to have a contract. Number 1, 2 or more parties. Number 2, it has to be enforceable. And number 3, the contract can be written, it can be verbal, it can be implied. So if it's normal business practice for you to take phone calls from customers, and the customer says, ship me 100 units, and it's just verbal, and you take that and you ship 100 units, if that's your normal industry practice, then that would be considered a contract. Even though it's verbal, you don't have a written document. And of course, it has to be enforceable. If the other party can pull out at any time without consequence, then the contract may not be enforceable, and the standard may not apply. So you have to have a contract, and it has to be a contract with the customer. So, what is a customer, or what makes the other party a customer? Well, number 1, they are purchasing goods or services that are outputs of your ordinary business practices. And number 2, they're required to pay. So again, this is pretty basic, but these are the definitions under the new standard of contract and a customer. Okay. So we have a contract with the customer. Now the question is, does the revenue recognition guidance apply? And there's some questions that you have to consider. Now I'm not going to read all of these, but I want to just point to a few at the bottom here. Does the contract have commercial substance? basically what that means is that based on the contract, the risk and the timing of your cash flows have to be affected by that contract. Okay? That's commercial substance. In other words, there's going to be an impact to you because of that transaction. And then finally, this last one is collection under the contract probable. And remember, we're at step one, identify the contract. So we have to assess the probability or the likelihood of collection at this point in order to have a contract. If collection is not probable, the standard is not going to apply. You can't recognize revenue if collection is not probable. So let's look at a couple of scenarios. So the first scenario, you have a customer that you've done business with for some time, okay? And you know the customer, and you know that the customer has been having some cash flow difficulty. And you know from talking with the customer that they are in the process of trying to arrange a line of credit with the local bank, okay? And you know that in recent years, the customer has taken longer and longer to pay. So again, if you use a facts and circumstances approach, you may conclude that in this case, it doesn't meet the collectability criteria. In other words, it's not that probable that we're going to be able to collect because of the financial situation of the customer. So in that case, you can't apply the revenue standard. Let's try another scenario. The customer gets a 2% discount if payment is made within the first 10 days of shipment, and the customer has a history of taking advantage of these discounts. So in the second scenario, again, you have a recurring customer, and the customer gets a discount, and you always expect the customer to take the discount because in the past, they've always taken the discount. In this case, you would say that collectability is reasonably assured. It's probable. Even though they get a discount, even though you expect them to get a discount, your assessment of the transaction is that we have a contract and we would expect to collect on that contract. The discount would be a separate factor that you would consider as you go through and analyze the contract. Okay?
Yeah, quick question about the probability of collectability on the previous case. So if we decide to go ahead and we're not sure if it's truly collectible, right? Or we go ahead with the contract, do we then just sort of hold the revenue until it actually gets collected? So it's just sort of, you see what I'm trying to say? Like,
yes.
I mean, it seems like you could take advantage of that actually. Like, oh well, we weren't sure if it was collectible, so we're just going to kind of wait
and just hold it. Well, that's a good question. Number one, there are some things that you can do to reduce that or to make it more probable to collect. So, for example, if you have a customer in that situation, you might have them pay part of it up front. And so if they pay part of it up front, the amount that remains outstanding is less, and you're more likely to be able to collect. But to get to your question, if you have a contract and you think that collectability is not...
well, you're on the borderline, right?
Yeah. So if you think it's not probable, you know, again, that's management judgment. You're going to have to make a judgment call on whether or not you want to go through and complete the contract.
The risk is worth it.
Right.
So let's say that we go ahead with the contract. Can we take the position though on the accounting side that, well, we're not going to actually recognize this until we truly collect it? You see what I mean? It's like a...
Well, if your conclusion is that it's not probable, but you go through and deliver the product, you're not going to recognize revenue, but you are going to recognize a contract asset and basically deferred revenue.
Okay, that's great.
Yeah.
You know, this is really going to set up the probability of disputes. Because on the finance side, on the finance side, we're going to be like, to our boss, no, you know, our president or CEO, and then the CEO is going to be like, are you crazy? Yes.
Yeah, it's already going to happen. I see.
Yeah.
Right.
I think you're going to, I mean, the beauty of GAAP in the past was what we said earlier was it was a standard, and we all knew what it was. Now, you're really setting up, I believe, controversy within organizations with this.
Yeah.
But anyway, I'm sure this has been discussed in other seminars.
I mean, you definitely have to, you know, consider the facts and circumstances and have a basis for the conclusion you make. Andrew?
Well, it's actually pretty close to the current gap. So when you actually ship the product and you believe that it's possibly not probable that you're going to receive, you would do the same thing that you do currently, and you would offset your accounts receivable for an allowance for doubtful accounts, which is what you do now. So when you set up an allowance for doubtful account, you're also not recognizing that revenue until you receive it. So it's not really any different.
I thought you could actually hold the cost sort of out of it too.
Oh,
you see what I'm saying?
Yeah.
That's why I'm saying lump all this together.
Yeah.
Decide.
Yeah.
Okay.
But the allowance is when it gets expensive, how would we hold it back to revenue? Because if you're, let's say
Well, you're still doing a bad debt
Yeah.
expense, so that offsets the revenue.
Yeah, well, that depends on your allowance.
Yeah.
It depends on your policy on allowance for doubtful accounts. If you have a standard policy where you're just following the aging report, that doesn't necessarily work.
Oh, if you're just applying a certain percentage.
Right. You don't use a
on-
subjective allowance method, right? You use an AR aging method, and you're strict to that method, then that won't apply.
Right.
Yeah, you kind of are required to look at a buy contract under this new standard. You can't just use your old, let's look at the over 90 day and do this policy.
This is terrible.
Which is kind of what you should be doing now, though, also. Yeah, because if you think any contract, even now under current US GAAP, is not probable, you should be booking an allowance. If it's material.
Okay, let's press on. All right, the second step is to identify performance obligations. Okay, so we've determined we have a contract with the customer, and we determined that it has commercial substance and its collectability is probable. So let's look at performance obligations. And what is a performance obligation? It's a distinct good or service or a bundle of goods or services promised to a customer in a contract. Okay? So again, back to my earlier example, you sell equipment and you provide installation services. Well, those might be distinct goods and services, and they could be separate performance obligations. So how do you determine if a good or service contained in a contract is distinct? So there's some contract-specific guidelines. So for example, is the good or service an input to produce the output promised? So for example, some of you, you sell machines and the machine gets customized to the customer request. And when you invoice the customer, in addition to the machine, you also include all the parts that you had to use to customize the machine. Well, those parts are inputs that are used to produce the final product, which is the machine. So those would not be distinct in the context of the contract. Is the good or service highly interrelated with another item promised? So an example here might be if you're selling a machine to a new customer and that customer has never used your machine before. They don't have any of your equipment. And so you sell the machine and you also provide training. Well, unless you provide the training, the customer is not going to be able to use the machine, right? And so in that case, the good and the service may be highly interrelated and they're not distinct. In other words, you can't separate the two in the context of the contract. And then some product-specific considerations. Is the good or service capable of being distinct? So this would be, for example, if I sell the equipment to the customer, will the customer be able to benefit from use of that equipment without anything additional from me? In other words, do they have resources? Do they have engineers who would be able to utilize the equipment appropriately without us doing anything further? If the answer is yes, then that piece of equipment may be distinct in the context of the contract. And then is the good or service separately identifiable? In other words, within the contract, can you identify that, okay, we have this service, we have this item, and they're all included? So these are the types of considerations you have to think about when you're looking at a contract and you're trying to identify the performance obligations. So let's go back to ABC Company. And we're looking at one of their contracts. And we see that they received a purchase order for 1 unit of equipment, 1,000 widgets, and that includes installation of equipment and training. The customer did not purchase the extended warranty. Remember, we give our customers an option to purchase an extended warranty. They did not purchase it. And as we mentioned earlier, the customer is eligible for a rebate. So remember, any purchases over $50,000, they get a 10% rebate on that amount in excess of $50,000. The total price on the purchase order is $100,000. Now also, in this contract, there's a provision that says the customer will get 5% off on future purchases of widgets if they purchase more than 1,000 widgets in the next 3 months.
On a Tuesday.
What's that?
9 a.m.
So we have some, it's kind of a complicated contract, but let's break it down into the performance obligations. So in this case, we're making an assumption that the customer is not going to be able to use the equipment without our people going out to install and provide training. Okay? And the other consideration is the equipment requires the widgets to function. And the widgets have value because they're used in the equipment. Okay? And so, based on those considerations, we said that these components of the contract represent one performance obligation. Okay? Now, what else do we have in the contract? Well, we don't have an extended warranty. But does anybody remember that the warranty, what's the base warranty?
Includes the maintenance.
It includes the maintenance, that's right. So here's the rule about warranties. If you give a warranty to the customer, if it's just the standard warranty, in other words, we provide a warranty for parts and workmanship and your basic warranty, that is not a performance obligation. That would fall under the accounting rules for loss contingencies. But if your base warranty includes a service, if part of the warranty is that you're going to provide an additional service, that becomes a performance obligation. And so in this case, we have a 2-year warranty, and we're required, under the terms of the warranty, to visit the customer for the next 2 years, at least once, and do a maintenance inspection on the equipment. That's a performance obligation in this contract.
But Brian, the purchase of the extended warranty is a moot point in revenue recognition, correct?
No, actually, if they purchase that extended, that's the other situation where you have a performance obligation under a warranty. If you offer an extended warranty and the customer purchases that's a performance obligation.
Which will impact revenue recognition?
Yes. So those are the two scenarios. In other words, you have your basic warranty involves some service that you're committed to provide. That's this one. Or you offer an extended warranty and the customer purchases that extended warranty. Then that's a performance obligation under the contract. Now remember, down here, the customer has, there's a provision that says if you'll purchase 1,000 units within 3 months, we'll give you 5% off. Now what is this? This is an option to purchase additional product. Okay? The customer doesn't get this unless they execute this contract with you. So that's another performance obligation embedded in the contract. So let's recap. So we got a purchase order from the customer. And the purchase order is for equipment, widgets, and installation and training. And yet, we've got other performance obligations embedded in that contract that we have to account for. Okay, let's press on. So step 3, determine the transaction price. So we determined we had a contract with the customer. It has commercial substance, Collectability is probable. We looked at the contract and we pulled out the performance obligations. So now we have to determine what's the transaction price. And here's the definition. The transaction price is the consideration that you expect to receive based on the contract. It's pretty simple. Now, some things you need to consider with regard to the transaction price. First of all, the transaction price increases for consideration that you're going to receive from the customer. So the purchase order is $100,000, and you're going to receive $100,000 from the customer. That's part of the transaction price. But the transaction price is reduced for consideration to be paid to the customer. So in our scenario, do we have consideration that's going to be paid to the customer? We've got a rebate, right? All right, the transaction price is also affected by collections on behalf of third parties. The example here might be sales tax. And then finally, if you have a contract that extends for more than 1 year, you have to consider the time value of money in determining the transaction price. Let's go on. A few other things to think about. Have you considered all transaction terms? What types of consideration? Obviously, consideration could be cash, it could be non-cash, it could be fixed, it could be variable. Let me ask you, in our hypothetical situation, do we have any variable consideration?
Wasn't the cash discount, if they're taking the 2%, 10, net 30, whatever?
Yes,
Reduction?
that's right. The discount, if they get a discount, remember, if they pay within 10 days. So that component is variable. So if consideration is variable, apply the variable consideration constraint. So basically what that means, if you have a variable component in the contract, you include it in the transaction price if you don't expect a reversal of the revenue. But if you expect, for example, in this case, you expect the customer to take advantage of the discount, then you're going to exclude that from the transaction price.
So the customer in your previous scenario, the customer that constantly takes advantage of that, we're going to recognize revenue differently for that customer. And the customer that never takes advantage of the discount, we're going to recognize a different amount for that customer.
That's right. Thank you.
Wonderful. Wow. That's really a good rule. I might just flip a coin.
Yeah. I'm just the messenger.
You know, I'm not poking fun at you. This is my first time really starting to get into this. And,
No,
I'm just trying to have a good time.
Good point.
It's all fun and games, right, until someone pokes an eye out.
Okay, let's take another look at this and determine our transaction price. Wait, maybe I got my slides mixed up. Okay, real quick question. Transaction price is $100,000. True or false? True.
True.
False.
The gross transaction price?
Yeah.
Trick question.
Sometimes.
Trick question.
Yeah,
Okay. So So the transaction price is not going to be $100,000, and let's look at why. The contract price is $100,000. So we've got to subtract some things. Number one, we have a rebate. Remember, consideration paid to a customer reduces the transaction price. And number two, we've got a discount. So again, this is basically the variable consideration. We expect the customer to take advantage of the discount, so we're going to reduce the transaction price for that piece. So the transaction price, everything else in the contract is fixed. Okay, Andrew.
So wouldn't you take the available rebate and discount and multiply it by the probability that you will the customer will take advantage of each?
So there's a couple of ways to approach that. So one way, if you have if there's more than one possible outcome, then you might want to take a probability approach and say, you know, outcome A, outcome B, outcome C, here's the probability, and estimate it that way.
I think I'll do a regression analysis when and I'm going to hire a quant that's going to give me that because I have, you know.
But in this case, there's only two possible outcomes. They either get the rebate or they don't get the rebate. So we're going to take the position that most likely they're going to get the rebate, and we're going to take the rebate, or I mean the discount out of the transaction price. Okay? So our transaction price is down here at $94,000. So we've gone halfway through the process. We've identified the contract, we've identified the performance obligations, and we've determined the transaction price. So this is the amount of revenue that you're looking at, the $94,000. The next step, allocate the transaction price. Okay, so here's the approach to allocating the transaction price. You have to take each performance obligation in the contract, and you've got to determine a standalone selling price for that performance obligation. Then you add up those standalone prices, and you determine allocation ratios based on the standalone selling price. And then you take the transaction price that you just determined, and you apply those allocation ratios to determine the allocated contract revenue associated with each performance obligation. So let's go back to our performance obligations, and let's take a look at them again. So we had 3 performance obligations, and let's look at performance obligation number 1. So this is delivery of 1 unit of equipment, 1,000 widgets, and installation and training. So we said that was a bundle. That was 1 performance obligation. Standalone selling price, we quoted the customer $100,000. Would that be the standalone price? Well, I'm going to say it's not, because this performance obligation actually has a rebate attached to it, right? Just under your current marketing program, there's a rebate attached to it. So the standalone selling price in this case would be the $95,000. Let's look at the next one. So if you remember, we have a warranty, and as part of the warranty, we have to go out and do maintenance work. make it more complicated, we don't offer this maintenance as a separate service. It's just part of the warranty. It's part of our commitment to our customer. So how do we determine the standalone selling price? Requires judgment.
I'm not that smart.
You just look like you're about to crack up.
Inside, I'm laughing so much.
So one way to think about it would be to use a time and cost approach. When we go out to do the maintenance, typically how long does it take us? You know, what would be our cost? Maybe you consider what's our normal margin on service, and you can develop an estimate that way. Are there other companies that offer a similar service? You might be able to look at another company in your industry that offers maintenance services and get an idea of what the standalone selling price would be that way. So in this scenario, we say that ABC Company used a time and cost approach, and they determined that for a 2-year period of maintenance, it has a standalone price of $2,500. Yes?
Just a quick one on this topic. You know, a lot of times you probably will have a standalone service that you would offer, but that margin is going to be significantly different than if you have that service done with the purchase of the machine or the equipment in this case, right? So, like, we don't have to use the street rate for, you know what I mean? This is all part of one transaction. Like you know, if it's $20,000 to do this, if you just buy it on the street without a piece of equipment, whereas with the equipment, it's, you know, it's part of the whole package. So I'm saying, like, is that part of the judgment? You can just ignore the fact that you quoted it at $20,000 if they didn't buy a piece of equipment?
So I think, so you're saying if you sell it separately, it would be much more expensive?
Yeah, because all they're buying is the service. They're not buying the equipment. See, it's tricky, right? Because you told us to break it out, but then...
Well, the standard does use the terminology standalone, oops, sorry.
Yeah, that's part of why I'm asking. It says standalone selling price. You know.
So, you know, I think for purposes of allocating, as far as I know, for purposes of allocating the transaction price, you would use that standalone. I mean, if that's a distinct performance obligation.
It's a different margin in that event.
You would still use it.
Oh, I'm gonna
Wait
exercise
until
my
he gets to
judgment.
that.
Otherwise, you're gonna end up with like a negative margin on equipment or something.
No. Wait until he gets to the end, because he's already over the transaction price. So he'll show you how to allocate those ends.
Yeah.
You work for CEH, right?
Yeah, I know. It's like
I'm your counter. Wholesale worker. What company do you work for?
That's right.
Okay, let's look at the third performance obligation. So this is the option to purchase additional items. So, you know, let me step back and mention one thing about this. You know, a discount or an option like this does not have to be considered as a separate performance obligation if it's not material. If it's not material in the context of the contract. So, you know, what would make something material in the context of the contract? Well, for example, in this case, if you remember at the beginning, we said that ABC Company, as their normal business practice, they give customers the opportunity to get a 1% discount, assuming they make payment within 10 days. But in this contract, there's an option if they purchase additional widgets, they'll get a 5% discount on those purchases. So in other words, 5% is bigger than 1%. So in this contract, then that would be considered a material. And so it's not simply looking at the dollar amount, but it's looking within the context of the contract and whether or not that would be significant to the customer. Okay? So let's think about this one for the standalone selling price. So let's say, assume the standalone selling price of a widget is $50. All sales are normally eligible for 1% discount. And so we say, how much do we expect to benefit from this option? Well, 5% minus 1% times 50 times 1,000, and that would be $2,000. Now, obviously, if the customer purchases more than 1,000 units within 3 months, they'll get 5% off of all of that. But for simplicity's sake, I'm just assuming that we're just working with the 1,000 units. And so, again, the potential benefit of the option is $2,000, and then management judgment, they assign a value of $1,200 as the standalone selling price for this option. You don't sell it separately. You have to evaluate it and consider possibilities to determine an amount or an estimate. So now we've gone through the 3 performance obligations, and we've assigned a standalone selling price to each one. And here we go. So the first one, $95,000, the second one, $2,500, and the third one, $1,200. That's a total of $98,700. Now, what was our transaction price?
$94,000.
All right. So is that the same?
Nope.
So that's why we calculate these ratios here. And then we go over to the transaction price. We use those ratios to allocate this transaction price to each performance obligation. Okay? Oops, let me go back. I want to make a comment here. This total, the total of the standalone selling prices is more than the transaction price. Okay? So basically the customer is getting a discount based on that difference. Now, in this case, I've just allocated that discount between these 3 performance obligations. But there could be situations where that discount relates to one specific performance obligation. In that case, you would apply that difference entirely to one rather than the other 2. And so, so for example, we have 98,700 here. Our transaction price is 94,000, and we determine that difference relates to this first performance obligation. So when we come over here, we would bring the standalone selling prices of these 2 items over here, and then this item would be adjusted for the balance that's left. Okay? So I just want you to be aware that there may be situations where that difference does not get allocated between all the performance obligations. It may be applied to a specific performance obligation. Clear as mud?
Right, so once the training is up, can you go back to the?
Yes, yes. This,
So, so once we've done the training and the customer is ready to use the machine, at that point, we can recognize the 90,000 as revenue, is my understanding correct?
yes. Let me get into that next, okay? So the next step is recognize revenue. So. Okay, now we're down at step 5, and that's recognize the revenue from the transaction. So under the new revenue standard, revenue is recognized as the customer obtains control of the promised good or service. Okay? So, and an important point here is control is evaluated separately for each performance obligation and is evaluated using a customer perspective. Okay? So from the perspective of the customer, when have they achieved control over the product?
Some customers say that.
Even though they've been using it, right?
Right.
Yeah. So again, you have to take the customer perspective to guide you in making those judgments. So in this case, we've got 3 performance obligations. The first one is the equipment, the widgets, installation and training. When do you recognize revenue? When you finish the installation and training. Okay? So you've delivered the equipment, you've delivered the widgets, you've installed the machine, and you've trained the company's personnel. You recognize revenue. So, whoops, let me go back. So that's going to be the 90,500. Okay. The maintenance service, annually over the life of the warranty as services are performed. So you do the maintenance service once each year. So when you do the service, you recognize part of the revenue. And then finally, the option to purchase additional widgets and receive a discount. I think possibly you could do it 2 ways. Number 1, recognize as purchases are made over the discount period or at the end of the discount period. The discount period is 3 months. They have 3 months to purchase 1,000 units to be eligible for that discount. So after 3 months, you'd be able to recognize that revenue.
So if 90% of your customers take advantage of that option, can you, across the board, make that assumption for all customers when recognizing this revenue?
I would think so, yeah. So now we would like to move to a brief discussion on some presentation, disclosure, and transition topics relating to ASC 606. And the first thing I would like to mention is actually good news. Although there are substantial disclosure requirements associated with the new standard, most of those disclosure requirements are not applicable to non-public companies. So, many of the disclosures you simply won't have to deal with. So let me talk a few minutes about some presentation matters, and this would be how the financial statements are going to change with regards to presentation. So the first item I'd like to mention is the contract asset. And a contract asset differs from a accounts receivable in that a contract asset is created when you satisfy a performance obligation under the contract, but are not yet entitled. You don't yet have an unconditional right to receive consideration from the customer. So for example, if you ship equipment to the customer, you've satisfied a performance obligation, but if you also have to install the equipment as a condition of the contract, then you don't yet have an unconditional right to receive payment from the customer. And so in that case, you would record or recognize a contract asset for the portion of your contract that's been satisfied. And conversely, on the liability side, if the customer has performed under a contract, and the classic example of this might be that the customer makes a payment in advance. They make a partial payment and you still haven't completed your part of the contract, but you've received consideration from the customer. And so in this case, you have to recognize that as a contract liability. Now, one point to keep in mind is that if you have, it would be possible for you to have a contract asset and a contract liability in the same contract. And in that case, if you have a contract and there is a contract asset and a contract liability, for reporting and presentation purposes, you have to net those and offset the liability and the asset. So if the contract liability is greater, then on the balance sheet, you would present a contract liability. If the contract asset is greater, on the balance sheet, you would present a contract asset. Now that netting only applies to contract assets and contract liabilities that relate to the same contract. Otherwise, you present each contract, you present the contract asset, the net contract asset or net contract liability for each contract separately. And then another presentation matter is, in addition to contract assets and contract liabilities, there may be other assets you need to recognize. An example would be costs that are incurred to acquire a contract. And another example would be costs incurred to fulfill a contract. So let's talk about costs incurred to acquire a contract first. So if incremental costs that are incurred to acquire a contract can be capitalized as an asset if the company expects to be able to recover those costs. Now, costs that the company would have incurred anyway, regardless of whether you acquire the contract or not, those costs are not eligible for capitalization. They just have to be expensed. But if it's an incremental cost incurred to acquire a contract and you have an expectation of either recovering the cost through reimbursement or recovering the cost through your normal profit margin, then the cost can be capitalized and put on the books. Now there is a practical expedient, and the practical expedient says that if the year in which the expense is incurred and the year in which it is recovered if that period of time is less than a year, you can just simply go ahead and expense the cost. On the other side, if you incur costs to fulfill a contract, those costs may also need to be capitalized based on specific criteria. And the criteria are as follows. The costs relate directly to a contract, and the entity can specifically identify the contract to which the costs relate. And the costs enhance the resources of the entity that will be used in satisfying performance obligations in the future, and you expect to be able to recover the costs. So again, whether it's a cost of fulfillment or a cost to acquire the contract, one of the key factors is whether or not you expect to be able to recover the costs. And so those assets would also need to be presented in the financial statements, and they must be presented separately from contract assets and contract liabilities. And you also have to assess these other assets for impairment when reporting for financial reporting purposes. So for example, if you capitalize commission costs associated with acquiring a contract because you expect to be able to recover those costs, maybe your parent company is going to reimburse you, and later you find out that the parent company is in fact not going to reimburse you. Well, at that time, you would probably need to expense those costs. On the income statement side, the standard requires that revenue from contracts with customers has to be presented separately from other types or sources of revenue. So for example, if in your business, if you are leasing equipment to customers and receiving rental income as a result, those income streams would need to be presented separately from the revenue you earn from your selling equipment or selling parts or whatever your business operation is. So these are a few of the presentation topics that you need to consider with regard to the new standard. As I mentioned, many of the new disclosure requirements do not apply to non-public companies. However, the objective of the standard with regard to disclosure is to provide sufficient information to enable users of the statements to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from your contracts with customers. And that's something to keep in mind when you're looking at your financial statements and considering your adequacy of disclosure. So very quickly, let me go through the two options that you have for purposes of financial reporting with regard to adopting the new standard. The first option is referred to as the retrospective approach, and the second option is referred to as a modified retrospective approach. And let's talk about these two options briefly. Under the retrospective approach, the new standard has to be applied to each period presented in a set of financial statements. So for example, if you are a calendar year entity and 2019 is the first year you apply the new standard, at the end of 2019, when you present comparative financial statements, 2018, 2019, the 2018 numbers have to be restated and presented in accordance with the new standard. Now, the standard does provide a few practical expedients to make this a little bit easier to apply. The first one is that you don't have to restate contracts that begin and end within the same annual reporting period. So those contracts have completed, you've recognized the revenue, so you don't have to restate those. The second practical expedient is that if a contract has variable consideration and the contract is completed on or before the initial adoption date of the new standard, you can use the transaction price at the date of completion rather than estimating the amount of variable consideration. And then finally, for the periods presented before the initial adoption date, you can elect to not disclose the amount of the transaction price allocated to the remaining performance obligations. And you can choose, and you can elect to not disclose when that remaining transaction price will be recognized. So you get a little bit of an exemption from some of the disclosure requirements. Now, one thing to keep in mind with the retrospective approach is that if you elect this approach, the disclosures for a change in accounting principle are required. So you will have to include those disclosures in your footnotes in the year of adoption. And so that was the retrospective approach. Now let's take a quick look at the modified retrospective approach. Under this approach, you adopt the new standard as of your application date. So going back to the example, if 2019 is your first year of adoption, then the standard would be applied as of 2019, and your prior year numbers would remain presented under current U.S. rules. And under the modified retrospective approach, the effect of the change in the standard on past years is presented as a retained earnings adjustment to your beginning retained earnings as of the initial application date. So under the modified retrospective approach, you present your comparative periods, 2018, 2019. 2019 would be presented under the new standard. 2018 would be presented under the old accounting rules, the current accounting standards. And you apply the new standard to new and existing contracts as of the effective date. And then, like I said, you have to book or recognize a catch-up adjustment to your opening balance of retained earnings to reflect the effects of the new standard. And after you book that adjustment, you have to disclose the amount by which each financial statement line item is affected as a result of applying the new standard and provide an explanation of significant changes. This is the modified retrospective approach. So that gives you an overview, a very high-level overview of the presentation, disclosure, and transition requirements associated with the standard. So at this time, I'd like to give the floor to my colleague, Barry Coyne, and he will talk for a few minutes about the new standard and some things you might want to consider with regard to your legacy systems. Barry? So this concludes the overview of the new revenue recognition standard. And at this time, I'd like to invite my colleague, Barry Coyne, to present a few comments with regard to your accounting software and any legacy systems that you may be working with as it relates to the new standard. So, Barry?
Thank you, Brian. One of the issues with 606 is the ability of your current legacy system to deal with it. And most legacy systems can't deal with 606. So you have to come up with a manual fix, which would probably be Excel. In Excel, you'd have to create revenue recognition templates and schedules and track those manually. You also have to build an Excel particular file that will create you journal entries in order to recognize revenue in the correct period. Obviously, this is prone to human error. It's not very, best path forward. It's inefficient, and there's increased risk for incorrectly recognizing revenue recognition. So our recommendation is to move to Sage Intacct. It's a cloud-based package, and it's an upgrade from QuickBooks. It's the only one endorsed by the American Institute of CPAs, and we are a partner of Sage Intacct. So if you have questions, feel free to contact CDH and learn more about how Sage Intacct can help you with 606.
So this concludes our seminar. Thank you for attending. And let me just mention, when you get your copy of the slides, if you look at the back, you can see our contact information. And also, we have contact information for some of our revenue recognition experts at CDH. Thank you.